Welcome to another episode of Founders Talk with the Impulse podcast brought to you by Rayhow New Ventures. As always, we explore the cutting edge of corporate innovation and venture building. And today we're diving into the topic of corporate venture building for hidden champions. I'm your host, Nils Wagner, and joining me is an expert on the forefront of this field, Kilian Karas from Boldheart. Kilian, welcome to the podcast. How are you?
Nils, thanks so much for having me. Pleasure.
So we just talked that you reside in Dublin normally. So tell us what you're doing in Dublin. What are you up to over there?
So, brief background about my story. So, started classically in business, did a dual study program, then a major business transformation at Hugo Boss, focused on helping the company ultimately transform their business model to become more appealing to the young customer groups. And at the same time, during my studies, started founding a first startup, a travel startup, a travel community based on my personal needs back at the time, and bootstrapped that for 2.5 years till I realized, hey, everyone likes it. No one wants to pay for it. And so then went back to the drawing boards, back to university, did the classical steps, VC, consulting, and ended up with Flink, which is, for those who don't know, a unicorn company in the quick commerce space. Help build that up, and then eventually from that transition to helping other corporates build up new venture models, and been doing this right now since 2.5 years with Boldheart, and yeah.
So at the moment, you're consulting other companies besides your ongoing entrepreneurial activities. Are you also investing, or are you just advising?
So the way we structure it is that we have this, what we call ignition phase, where we go in with a corporate, go explore the opportunities. And through that process, we understand whether A, the topic is interesting, but B, also whether this type of collaboration or how this type of collaboration could evolve in future. And if both parties say, hey, this is something where we have the conviction that we want to go deeper, then we also allocate and co-invest into these companies to jointly build those new ventures.
Okay. And so here you're often then working with corporates and maybe, in some cases, what we call hidden champions. So maybe just quickly describe what you consider as a hidden champion.
Right. So hidden champion in our understanding is a SME that is leading in their field. It's very typical here in Germany and also in the DACH region. So these are often family-owned firms that have been around for generations, that really have occupied and successfully occupied their niche and are in what they do just, worldwide experts. And often, and this is why they're called hidden, they're in domains that are not necessarily known to the outside world. Those can be tiny screw manufacturers, or not tiny, but like screw manufacturers. I believe Rayhow is also one of a company which you could call a hidden champion. So in diverse fields, and that's how we look at the field.
Yeah, no, I think actually there's many touch points during kind of a typical day of any consumer where he's directly or indirectly interacting with Rayhow products, but of course they have no idea. So we're definitely an example of a hidden champion. Many areas where our products are applied, where users are not really familiar with our company or let's say our brand. Maybe, just since we're now here at this point, what advantage does corporate venturing have for these kind of companies? How do you think about that?
So essentially, I think there's an interesting report. And to give a bit of background up front. So if you look at the stock listed companies, 80 years ago, their tenure on the stock exchange was 67 years. Today, it's 15 years. So over a span of 80 years, it's basically shrunk to only 15 years. It's basically been cut into 4. And the simple reason being is that too many companies become very complacent once they reach a status where they think they're successful. And so then, obviously, over time, new opponents enter the market and try to disrupt the field. And in an ever accelerating world, especially with digitization, with AI accelerating this entire process, this lifetime is shrinking more and more. And so the problem we see is that if companies want to remain competitive and want to succeed, they need to keep innovating. And so corporate venturing essentially then becomes one of the tools that helps you, that equips you with that capability of continuously going out there and essentially building on the spirit that was at the very beginning of the company, that formed the company, that ultimately led to this success, so that you're basically looking out and scouting, where is my next growth field? Where can I basically build a company the same size as I am today, but possibly in a different field, to prevent the same destiny that you ultimately will vanish in the next 10, 15, maybe 20 years. And there's an interesting report also from McKinsey that states that 50% of the revenue will come from products and services that have not been created yet, and that within a time frame of 5 years. So if you take that into consideration, then you have to ask yourself as a hidden champion as well, what is it like? What kind of new markets are out there where I can use my capabilities to build something that is the same size as my business today or even bigger?
I mean, one example that I like to cite here is definitely not a hidden champion, but Kodak in the mid 70s was the most valuable company in the world, and actually around that time, 1975, invented the technology for capturing pictures digitally. Basically, they invented the digital camera, and through a combination of maybe hubris and also very much what you're saying, just looking in the rearview mirror at past successes, they actually shelved the project because they were afraid it might cannibalize their business. And of course, this would have enabled them to still be a relevant player today in the age of social media, in the age where, digital images are absolutely pervasive and all around us. Instead, I think they went chapter 11 in 2011 or something like that. So, it's a good example and a prominent example of a company that did not manage to stay relevant, even though it was highly successful. If we look at the term corporate venturing, there's different, let's say, subsets of corporate venturing. So do you want to expand a bit on the different tools in the corporate venturing toolbox?
Absolutely. So when we look at corporate venturing, we see different categories that you have to build on and that you have to master. And they're not mutually exclusive. I think you need each of these tools for specific situations. So typically, when you start out in a classical innovation process, right, you start out, you try to figure out what are you trying to build. And so here, what you can do and what we see in very successful cases is that companies either have their own CVC unit, so corporate venture capital unit, which gives them an idea of what's happening in the market. So they constantly get deal flow, they constantly get new ideas, they constantly have an update and real-time insight into what is happening out there. Now, an alternative is that you basically collaborate with such players, that you have a deal, for instance, that you invest into a VC, or that you simply have good connections, a good network with a VC that helps you understand what's going on in the market. And what you want to avoid here is that ultimately because the VC thinks, hey, the corporate maybe can give me some cash into startups that are otherwise not fundable. We just like give them the second or third tier options so that they can still chip in money to basically cover our backs. So that's something to be very mindful of. Now, the other alternative is that you look inside, that you see what is happening within the organization, what are currently initiatives, what is also the feedback from the market that, for instance, the sales team or the customer service team receives, to kind of have a constant microphone or sounding board in the market that gives you like a point. And for instance, the project we're working on right now, essentially that's how the entire venture project came about, is that the sales unit came about and said, hey, what we keep observing in the market and what customers keep asking us is X. And we believe that this is actually something that has huge potential also when it comes to enriching our business model with digital ideas or with a digital service. And so that's another alternative. And so essentially there's a couple more tools that you can use to get an understanding of the market and then ultimately put that into a framework that helps you to effectively A-test these ideas. And then once you successfully validated the hypothesis, to then roll it out. So typically the way we think about it is a 3-stage process. So what I already described is the understanding part, which really, if you want to break it down to the bare essentials, it's about talking to customers, understanding their pain points. That's it. Okay. It's that simple. And yet so many people do that wrongly because they try to interpret something that actually customers don't say, which is something we can also touch upon later. And then once you have that clear idea of a pain point, you then want to move on and identify, okay, what are potential solution ideas? And what are the underlying hypotheses that you need to validate before you invest capital big time? Because that's another fallacy. A lot of corporates and also startups, but often corporates, because they have such bigger investment volumes, that just throw money at problems hoping that something will stick. Whereas if you go the smart way about it, you first understand and validate what are the critical hypotheses that I need to, either falsify or verify through tiny experiments. And that can be literally taking a sheet of paper, drawing something onto it, handing that in front of a customer and saying, would that solve your problem? Playing it out, role play. It can be simple. And once you have that, you can then move on and say, okay, now we're convinced that exactly this way of building solution is the right way. Then you invest the capital. And I think then it's also the point where typically you build the MVP, you launch it to market, you acquire first customers, and you then do the typical scaling process where you see where's the biggest pain point right now internally, solving them, and then ramping up the company over time.
Maybe just on that later point, if you successfully navigate the project to a point where the corporate could then say, okay, this really is promising. Let's start investing a significant means into this opportunity. How do you usually go about doing that from a practical perspective? I mean, are you then kind of spinning out this project as a separate legal entity or venture? Or do you see actually different options that a corporate could follow at that point?
Yeah, I think that really depends on the structural requirements also of the case you're building. But typically, especially in highly regulated industries, it totally does make sense to spin out, because what you want to do is to remove the risk, de-associate the test, which is live in the market, which in the worst case is going to harm your reputation. You want to avoid that impacting the mothership. So in that case, it does make sense to have a very separate unit. If, for instance, you say, hey, this case we can use it internally first to like help our, let's say, sales process improve, and then through that we kind of also get first traction. And you don't necessarily have to spin it out. I think eventually, if you talk typical corporate venture, you will always reach a point where it needs to be an alone standing entity. We actually today had a discussion with a client who said the corporate venture shouldn't be the fuel, it should be the car. Meaning it should be something on its own that works. It shouldn't just be like an accelerating substance for the company itself. And so in order to eventually arrive at the point where you say, I can spin this out, there needs to be very clear alignment on the corporate goals. And that needs to happen way before you even think about doing this. This is typically the very first thing that if you ever think about building a corporate venture, you need to think, how does this align with my strategy? And is the top management on board? Like, do I have the buy-in that this is the right way to go? Because we see that we can leverage our assets and we can bring those into or in a form that ultimately furthers the company's goals. And then if you have that buy-in, you then go ahead and set up a venture board, which ultimately signs off on all these decisions to eventually, for instance, provide the capital to this new venture, to place the team on it, to, in general, unlock the resources that you need for this venture to succeed.
Okay. Now, I mean, I think if we look at the startup world, we see that, from initial conception through validation, through then really this whole kind of arduous phase of product market fit. So, everything that we would consider as kind of early stage in the startups, in the startup world, can still, take 2 to 3 years to deliver clear results before the startup would really then enter a growth phase where basically it's clear that the product is not only addressing a real need, but that you actually also find customers to pay for it. And now it's just about scaling, and that's usually where startups then need substantial capital, right, to be able to build the organization, to be able to really execute on a growth plan. So here we're maybe then already in year 3 or 4 when we talk about maybe a Series A, right? Now, how do you what's your stance there? Because I think 3 to 4 years is quite a long time for a corporate to wait, right? It's usually we think in financial years, and then maybe we do a bit of midterm planning, but latest by year 3, no one's really sure if that's exactly where we're going to land. So how do you deal a bit with those maybe 2 different speeds or timelines, and how do you bring that together?
That's a very good question, because I think the easy part is executing the idea. The hard part is ensuring that everyone is on board and remains on board. Because as you described, right, latest by year 3, a lot of people get nervous. A lot of people are like, okay, we wanted to reach 50 million, 100 million in, for instance, market capitalization. We're at 2. We have 1 year to go from 2 to 50 or to 100, or maybe 2 years. And so what's super crucial is already when you start the project is to kind of like prepare people mentally that this moment is going to happen. And it always happens. So investing the time, even though it seems maybe a minor thing, but really investing the time up front to build that storyline, to build the conviction, and to build the mental roadmap and the roadblocks of what will happen. Because then people are way more assured that this is part of the plan, that this is going to happen, and they remain calmer when the actual situation happens. So it's kind of like a contingency plan, if you will. But that is something that you got to do all the way in the beginning when everyone's still enthusiastic and people are like, yay, this is going to be cool. So it really comes down a lot to communication and preparing people. And then I think one crucial point is, especially talking right now about family businesses in particular, they have one big advantage. And the advantage is that they're not so much driven by the capital markets and by short-term stakeholder expectations. And so essentially, if you look at the history of many of them, they're 100, 200, maybe 300 years old. So they have a bit more time. And I think appealing back to the grandfathers, the grandmothers, great grandfathers, whoever built that company, and showing that, hey, it really took a while for this thing to take off. I think that gives a bit of confidence that this also might take a bit more time. But obviously, and that's the last point to this, it shouldn't come at the detriment of like having a living dad. If particular KPIs and if particular indicators are not showing that this is going somewhere, cut it and cut it fast.
Yeah, I think there's quite a few things there maybe to unpack, but I think clearly the takeaway is expectation management is very important, just because it's a different kind of discipline than when you compare it to, let's say, a mature running business, right? There's a completely different dynamic. And I actually try to do the same thing. I actually try to remind our team regularly that our company, Rehau, was actually also a technology startup when it was founded by my grandfather as a young man 75 years ago, right? And so that we're actually trying to get back a bit to that entrepreneurial DNA. But again, in a corporate world, to create the kind of space that's necessary where people then have that patience is definitely challenging. And maybe just to follow up on another point you just touched, the need to also know when to quit is, I think, generally a very important skill in life. It's kind of like, learning how to say no is more important than saying yes. But, having said that, we also know that, if you look at, let's say the idea phase, right? When someone is sitting down and he has a first idea that might, lead to him founding a startup, we probably have a success rate of in the per mil area. And then, from startups that are also funded maybe with angel or seed money, we still have a high rate of fallout, right? So I think, depending on how you look at it, depending on the statistics, it's only a few percent of companies that ultimately make it to let's say, real success and growth. So how do you incorporate that statistical fact into your approach when it comes to venture building, or how do you also inform or sensitize a corporate on that fact of life?
I think that there's a couple of interesting aspects you touched upon. So the first thing I want to mention is that if you look at all the successful corporate ventures that have been built over the last years, 66% have been built by just 20% of companies. Which means that a majority of companies has been very unsuccessful. But, and this is the crucial point, why I'm tying this, is that it means you have a compounding effect. So typically, if you start to cycle or learn how to cycle, you fall, and you fall often. Over time, you get better. And then there might be another roadblock and you fall again. Now, the same really goes for corporate venture building. So to what you said is obviously the failure rate is fairly high. But in order to maximize the output and maximize the efficiency of the process and really also to learn the do's and don'ts, you have to repeat it and ideally do it with several startups or with several corporate ventures at the same time. Because that really helps you to learn what to do and what not to do. And this is then ultimately, if you look at the reasons why these 20% of ventures built so many comparably successful ventures, it is because they really compound the learnings and build a streamlined process, if you will, that helps them to churn out ventures on and on and on and on. And so coming back to your question, that basically means that you need to start, and you need to start with several startups and ideas, and then, go learn from there. And I think there's a particular amount of learnings that someone who is experienced in the field can help you, let's say, anticipate, so you don't have to make all the mistakes yourself. I think there's certain things that the organization has to learn. And what's important here is that also means you need someone who's dedicated to this. You need someone who's ultimately in the driver's seat, who is that kind of corporate entrepreneur who has the good connections internally, who understands the process and who can drive it forward, who can collect the learnings, and then have that person execute it over and over again.
Okay, so you really think it's important to aggregate that specific skill set, to learn also through experience, to really learn also then through failures, and then eventually you're on this a learning curve that will automatically increase the success rate. Is that correct?
Look, because what's the option? I mean, you can obviously get someone on board to do it for you, but you forever will be dependent on that person to do it.
So you clearly advocate then for building that basic skill in-house.
Eventually, yes. I think if a corporate is serious about becoming innovative, you need to invest that resource. It can't be that you dedicate hundreds of millions partially into maybe upgrading an IT infrastructure, but really when it then comes about the longevity of your business, you can't even cut out the person for 3 months of their from their operational duties and be like, right now, go do this exploration process, figure out what we can build, and then if we find something that's worth building, go build it. I think otherwise you're being hypocritical.
I think it's an interesting example because it just, it shows how corporates think. I mean, corporates have been basically, shaped over many, many years, if not decades, through the test of time and the pressure of market, which really turns them into, kind of a risk mitigation machine, right? So it's, the management is always trying to eliminate risk out of the equation. And that's why they have no problem spending tens of millions on IT upgrades. It's a super low risk investment. There's probably going to be a pretty straightforward payback on that investment. And of course, with, venturing, there's a completely different risk reward profile. So again, making those kind of decisions, even if it's for small amounts, it kind of goes against the nature of, let's say, professional management in a very mature business. So that's, I think, also just something, that corporates need to be aware of, and again, create the space for that to work. Find the dedicated people that then really are able to focus on that. And then, like you said, they need to reset their expectations when it comes to these cases and how they look at it. So that's definitely something that you need to go into with very much open eyes, right?
And I think what's also super important here is, and we talked about the venture board earlier on, is to like make it a challenge, make it something that's exciting, like make it something where like the board's like, hey, I can enlarge my horizon. I'm I learned the skills a typical VC investor would have of looking at the market, understanding what the opportunities are, and basically calling the shots. And this is why before you actually start this entire process, which I described also of like exploring the opportunities, doing the little tests, the very first thing you would want to do is to find the people you want this to do with internally, possibly also externally to shorten the learning curve. But as I said, internally, it's super crucial to have someone. And then also to educate and like to pick a venture board and to really educate these people of what it is to think like a VC, to invest like a VC, and to call the shots like a VC.
Okay. But let's assume that all of this is done successfully, right?
Yeah.
So you set up a unit which again is working on a different kind of timeline, which has a completely different attitude towards risk, etc. I mean, culturally, this is then automatically, let's say, relatively foreign or exotic within an established corporate. At the same time, I'm assuming that there, certain assets you want to leverage, right? Like certain insights, certain expertise that gives then this new venture an unfair advantage. But again, there's this kind of clash of culture, right?
Right.
Or maybe to put it a bit differently, the people that are supposed to be providing resources, providing these assets, they probably won't really benefit from that in a useful amount of time, right? So I'm just trying to point out a bit the potential for conflict and the potential for misalignment of incentives and interests. How do you see that, first of all, and second of all, how would you then advise to deal with that?
There's a lot to unpack here. So first of all, I agree that what happens often in the market is that you have these venture units somewhere in Berlin and like, hey, the cool guys, like they just do something and they don't have really a lot to show for. Like they're just basically doing a bit of innovation theater in the eyes of the people that are, let's say, operationally involved, running the day to day. And occasionally they come around and be like, we should do this. And you're like, okay, but based on which grounds? So the problem is often then that there's, and again, comes down to communication. There's a lack of communication and lack of inspiring people to come join on the journey. So previously, what I said about Hugo Boss is basically the experience that we had back then was that a lot of people were super skeptical about this completely new operating model we were building. And so what needed to be done is to essentially, with this small dedicated team, provide this lighthouse project that would start driving a bit of momentum so that people would actually start to understand, hey, there's something happening and this change is possibly good. And that would give people the curiosity to start learning more and eventually to be convinced that what was being done was ultimately something that would also benefit them. But the crucial part here is to inspire the people through the actions you're taking, to take them along on the ride, and to constantly keep them in the loop. Because otherwise, I totally agree, you end up with this divide where ultimately no one benefits. And so that's the first crucial part. The second thing is that you need to be clear how this entire structure has to look like. in terms of clear goals, effective top management buy-in. And in this venture board that I mentioned earlier, if you have the right people that have the access to the resources that you mentioned, these people then play a crucial role in pushing the progress you're making, the updates into the organization to then say, look, we're doing this, but we want your buy-in. We're going to do a roadshow, whatever it is, to kind of take you along, and then to, through that, motivate people to dedicate their resources and give access to their resources also internally. Now, the important thing is still to have that top-down push to just say, hey, we need these resources. But it's kind of like a push and pull, like it's both. And without one or the other, the chances are that they will fail.
Yeah. No, look, I mean, based also on our own experiences, I really think getting that alignment of interest or ultimately of incentive, it's a really tricky part, because you're asking for something, but you're not able to really offer kind of a direct payback, because you're saying, look, I need this now, and maybe 3-4 years down the road, I'm successful. And again, that's just a, different set of incentives. And that's why it's then sometimes difficult to successfully leverage those advantages. And I mean, ultimately, that's really what makes, corporate venture building in that sense, just a very, very tough discipline to execute successfully on. But maybe here, Kilian, and I'm a bit mindful of the time. Time is flying. But do you have some examples of, let's say, your favorite successful corporate startups? Maybe many people don't even know they're corporate startups. Can you give us some examples from the field?
I think what's super interesting is in China. I keep forgetting the name of it. But it's this insurance company that's built 7 unicorn companies. I would actually need to look, I keep forgetting the name. I can tell you, text you after. But essentially, they're one of these examples that show what's possible.
Yeah.
Like they went ahead, and it's been a 20-year journey for them. So they went ahead and completely started with an internal digital transformation to lay the foundation, the data foundation, the insight foundation, to then, once they had all the data together, they said, okay, now we have all this data. What can we do with it? And started exploring different use cases and built several products and services around this that are ultimately, all turned out to be unicorn cases, because they had, over time, and again, coming back to this learning and falling part, they just over time perfected the process, and so we're able to really drive it forward. Now, I think in Germany, there is RWE, who's been fairly successful in the field. But ultimately, if you look around, there's unfortunately not many cases where really corporate venture building has produced a lot of highly successful cases yet. Which I think there's a variety of reasons. I think it's been a fairly new discipline, which really has only started being at the top of the mind of board members in the last 5 years. And typically, if you look at the, let's say, journey it takes to really build a successful company, yes, there might be the 1 or 2 outliers that reach unicorn status by year 2 or 3, but ultimately it's often like a 10-year journey. So I'm convinced that, especially with 1 and 3 board members these days saying, hey, our market is being disrupted, and one of the major levers to address that is corporate venture building, I think we'll see much more in the future.
Great. Well, look, let's leave it there on that optimistic outlook. Definitely corporate venture building as an important tool in corporate venturing, and therefore in the strategic development of any organization, something to be looked at. And so thank you very much, Kilian, for sharing your expertise. Of course, we could go on and on and on this topic, but I think we'll leave it there for now, and possibly we can reconnect then to talk about some other corporate venturing related topics later on. So thank you, Kilian. It was great talking to you. And
thanks for having me.
Thank you also to our listeners for tuning in. Be sure to catch us here again with our next podcast, and follow us wherever you get your podcasts. That's it for today. Over and out. Thank you.